Rogers Communications just offered voluntary departure packages to roughly half its workforce, and the same week its stock jumped 8.2%. That contradiction is the question worth examining. The instinct is to read mass buyouts as distress. A company shedding costs is a company losing ground. But the market's reaction points somewhere else entirely, and understanding why requires looking past the headline number. Rogers had approximately 25,000 employees at end of 2025. Around 10,000 of them, excluding MLSE staff, on-air talent, union workers, and the Blue Jays, were made eligible for voluntary departure packages. The company declined to set a public reduction target, and history suggests only a minority of those offered will actually leave. The real workforce impact is unknown, and that uncertainty is doing a lot of work in this story. What the market appeared to price in was not the layoffs themselves, but the signal behind them. Rogers also beat Q1 2026 consensus estimates and announced satellite coverage expansion. Cost discipline paired with a revenue beat is a different narrative than cost-cutting under duress. The tension is whether this is a controlled restructuring or the leading edge of something more structural.
The debt load is the structural constraint that makes every other decision legible, and without understanding it, the buyout program looks arbitrary. Rogers carried $34.7 billion in long-term debt as of March 31. That figure accumulated rapidly across three major moves: the $26 billion Shaw merger in 2023, the $4.7 billion purchase of Bell's MLSE stake, and the $11 billion NHL rights renewal. Each was defensible individually. Together, they created a debt service obligation that now constrains capital allocation at precisely the moment revenue growth is decelerating. The company has been active in unwinding the pressure. It sold a $7 billion stake in wireless infrastructure to Blackstone in 2025. It is now exploring a minority stake sale in its combined sports portfolio. Both moves convert illiquid strategic assets into debt reduction capacity. That is a deliberate sequencing. Acquire scale, then monetize the assets that don't require operational ownership. The 30% CapEx reduction for 2026, roughly $1.2 billion less than the prior year, fits the same logic. CEO Tony Staffieri has been explicit that regulatory conditions are a direct driver, calling the environment punitive. That framing matters because it shifts the cost-cutting narrative from internal failure to external constraint. Whether that framing holds depends on whether Canadian telecom regulation actually changes, and that is a policy variable, not a management one. The PEG ratio of 0.32 is the number worth noting here. A PEG below 1 typically signals a stock priced below its growth rate. At a price-to-earnings ratio of 3.81 and a stock trading near C49.67 against a consensus analyst target of C58.48, the valuation gap is not subtle. The question is what closes it, and whether debt reduction is the catalyst or just a precondition.
The detail that reframes this story is not about Rogers specifically. It is about what Desjardins analyst Jerome Dubreuil said afterward, and what it implies for BCE and Telus. Dubreuil described Rogers' move as potentially among the largest telecom workforce reductions in recent memory, and noted there is room for more cost-cutting at other large Canadian telecoms. That is a direct signal that BCE and Telus face the same structural pressures and have not yet acted at the same scale. If Rogers is the first mover in a sector-wide adjustment, the investment calculus shifts. Early movers in cost restructuring tend to absorb the headline pain, while late movers absorb it later with less favorable market conditions. The academic framing from Ivy Business School is equally important and largely absent from the market coverage. The argument is that AI's growing role in network management has been reducing labor intensity in telecom for years. This is not a Rogers story. It is a sector transformation story, in which Rogers happens to be making the adjustment most visibly. The workforce reductions are not purely a response to short-term revenue pressure. They reflect a durable shift in how networks are operated. That distinction matters for how long the cost-cutting cycle lasts. If the driver is purely cyclical, slower subscriber growth, lower average revenue per user, then relief comes when macro conditions improve. If the driver is structural, AI displacing network labor, then the labor intensity decline continues regardless of the revenue environment. Evidence points toward the structural explanation being at least partially true, which means BCE and Telus are facing decisions they have not yet publicly priced. There is also a regulatory complication unique to Rogers. As a condition of the Shaw merger approval, Rogers committed to creating 3,000 jobs in Western Canada over 5 years and maintaining them for a decade. The buyout program raises a direct question about whether those commitments survive the restructuring. If regulators scrutinize compliance, the cost of the buyout program may include regulatory friction, an element the market has not priced.
Two plausible paths forward diverge at a single condition, whether Rogers' debt reduction timeline accelerates or stalls. The constructive path runs through asset monetization. Rogers is exploring a minority stake sale in its sports and media portfolio. If that transaction closes at a valuation that materially reduces debt, the company's financial flexibility improves faster than the market currently assumes. Combined with lower capex and a leaner cost structure, free cash flow generation improves. 8 of 11 covering analysts already rate the stock a buy, with JP Morgan's target at $65, implying over 30% upside from recent levels. That upside is not built on revenue acceleration. It is built on margin expansion through cost reduction. If the buyout program generates meaningful take-up and the sports stake sale closes, the margin expansion thesis has its 2 required inputs. The risk path activates if the debt burden proves stickier than the asset sales can resolve. The MLSE remaining stake acquisition, expected to cost upward of $4 billion, is still pending. If that closes before the sports portfolio minority sale generates proceeds, the net debt position worsens before it improves. Revenue growth would need to hold at current levels to prevent a deteriorating debt-to-EBITDA ratio. The threshold to watch is whether the minority sports stake sale is announced before the remaining MLSE acquisition closes. Sequencing determines whether the balance sheet tightens or loosens through the second half of 2026. The satellite coverage expansion is the less discussed variable that belongs in the upside scenario. Cutting traditional capex while simultaneously extending coverage via satellite is a capital efficiency move, achieving network reach without the per-tower cost of terrestrial buildup. If satellite connectivity becomes a meaningful competitive differentiator in underserved markets, it could support subscriber retention at a lower cost base than the prior network build model required. Rogers sits at the intersection of 3 converging forces: a structural labor transformation in telecom, a debt load that demands deleveraging, and a valuation that already discounts significant pessimism. The buyout program is not the story. It is the symptom of a company resetting its cost architecture under all 3 of those pressures simultaneously. Whether that reset compounds the pressure or resolves it hinges on execution in the next 2 quarters, and the Canadian telecom sector is watching how the take-up rate lands before deciding whether to follow. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.